Why gold and silver prices may surge before another pullback. Right now, gold is sitting on a line on the chart that traders have been watching for months. A line that, if it breaks, could send prices climbing fast within days. At the same time, nearly 20 million ounces of gold contracts are quietly being rolled forward behind the scenes, and tensions overseas are rising once again. But here's the twist. This move may not be built to last. Stay with me, because what happens next could change everything. Gold and silver have been on quite a ride this year, and this week, things are getting even more interesting. Prices are sitting right at a key turning point, and traders around the world are watching closely to see what happens next. To understand why, it helps to look back a little. Since early 2024, gold has climbed a long way, from around $2,000 an ounce to well over $4,000 today. That's a massive move, and it hasn't happened in a straight line. Along the way, gold even touched $5,500 before pulling back sharply. This kind of swing naturally makes people nervous, and nervous investors often start asking questions. Unfortunately, in markets like gold and silver, those questions sometimes turn into rumors, and rumors spread fast. This week, one of the most talked about rumors involves China. Many people online have been claiming that a major reform is happening in the Chinese gold market, and that it will completely change how gold trades around the world. According to industry analysts who track these markets closely, this claim is simply not true. What is actually happening is far less dramatic. China has been slowly phasing out leveraged retail gold trading, meaning ordinary investors borrowing money to bet big on gold prices over the past several years. This week, the last of those leveraged positions are finally expiring. That's it. It's a scheduled, well-known regulatory change, not a sudden shock to the system. Analysts explain that this kind of confusion isn't new. Every few months, a new theory appears claiming something catastrophic is about to happen in the gold market. Sometimes it's about a supposed shortage of physical gold. Other times, it's about central banks secretly changing the value of gold, or major economies planning to back their currencies with gold again. Time and again, these theories fail to hold up once people actually study how the market works. Take the idea that there isn't enough physical gold to go around. In reality, most people who trade gold through futures and options are not trying to get their hands on real gold bars. They are using these tools to manage risk, not to take physical delivery. So even when trading volume rises sharply, it doesn't mean the world is suddenly short on real physical gold. Another myth involves so-called weaponization of the dollar. Some claim this is a brand new development, but historically, major currencies, including the dollar, have always played a role in international politics and economic pressure. What has actually changed is that central banks around the world are now holding more dollars than ever before in history, the opposite of what many rumors suggest. Even stories about countries selling large amounts of gold often turn out to be far less exciting than the headlines suggest. In some cases, a country simply exchanges older gold stored abroad for newly refined gold delivered to a location closer to home. Technically, a sale took place, but the motivation was usually about location and trust, not financial trouble. So why does this matter for viewers right now? Because separating real market moving events from noise is exactly what helps investors make smarter decisions. Gold and silver are genuinely at an important technical level this week, and there are real, verifiable reasons prices could move higher in the short term. But understanding which stories are fact and which are simply internet noise is the first step to making sense of what's coming next. Right now, gold sits at a genuinely important spot on the price chart, and this is where the technical story gets interesting. Analysts point to two major trend lines. The first is an upward line, stretching back to early 2024 when gold traded near $2,000 an ounce. That line now sits close to $3,800, and it acts as a kind of safety net, a level where buyers have historically stepped in. The second line tells a different story. It's a downward trend line, formed after gold spiked above $5,500 back in January. Since then, prices have been drifting lower along that line. And here's the key detail. Gold is currently trading right where that downward line sits. If the price manages to push above it, chartists say it could open the door to a fast move higher. This is the kind of setup technical traders watch for very closely, since a large majority of trading activity in gold and silver is driven by exactly this kind of chart analysis. But charts alone don't move markets. Real-world events matter too, and there's plenty happening right now. Tensions between the United States and Iran have picked up again in recent days, following the expiration of a temporary truce. Alongside this, there have been reported attacks on oil tankers and shipping routes near key global choke points. As a direct result, oil prices have pushed above $100 a barrel. When political and military risks rise like this, many investors respond the same way they always have, by shifting some of their wealth into gold and silver, seen as safer places to store value during uncertain times. There's also a quieter, more technical factor at play involving the futures market itself. Every year, as a major contract month approaches its delivery date, large amounts of open contracts get rolled forward into future months. Right now, that's exactly what's happening with August gold contracts. Just weeks ago, there were more than 40 million ounces tied up in August contracts. That number has already dropped to roughly 19 million ounces, as traders shift their positions into October and December instead. Most of that remaining 19 million ounces still needs to be bought back and rolled forward before the delivery period begins. That kind of buying activity, some analysts note, has the potential to push prices higher in the short term, especially when it lines up with the technical breakout level described earlier. Now, back to China, since this is where so much confusion has been spreading. It's important to understand how the Chinese gold market is actually structured. The Shanghai Futures Exchange and the Shanghai Gold Exchange exist mainly for large institutions, banks, trading companies, and industrial users. They were never really designed with everyday retail investors in mind. Over recent years, that gap led to a boom in unregulated leveraged gold products aimed directly at retail investors, some of which turned out to be unreliable or outright problematic. Since 2020, Chinese regulators have been steadily working to phase these risky products out, specifically to protect everyday investors from both excessive volatility and unreliable investment schemes. What's happening this week is simply the final stage of that long-running process. The last leveraged retail positions expiring exactly as planned. Meanwhile, everything else in China's gold market remains fully open and active. Retail investors can still buy physical gold bars and coins. Gold savings plans remain widely available through banks and precious metals dealers. Gold-backed ETFs continue operating normally, and many investors have actually been shifting toward them. The futures markets remain open to both institutions and retail participants, and the physical exchange, where real gold moves in and out of the country, continues functioning as usual. With gold and silver sitting at such a critical technical point, the natural question becomes, who actually feels the impact of these price swings, and why does it matter beyond the trading floor? On the investment side, the consequences are fairly direct. When gold and silver prices rise sharply, portfolios that are heavily weighted toward precious metals benefit. Many individual investors, especially those who view gold as a long-term store of value, see this as validation of their strategy. At the same time, sharp price swings create risk for anyone using leverage, meaning borrowed money to amplify their bets. When prices move quickly in either direction, leveraged positions can produce outsized gains or painful losses in a very short period. Interestingly, most large gold traders and bullion banks are not necessarily celebrating or panicking over these swings the way individual investors might expect. Many of them operate hedged positions, meaning their physical holdings and their futures contracts offset each other. So when prices rise sharply, a loss on one side of their books is often balanced by a gain on the other. In fact, some of the largest bullion banks have reported record earnings recently, not because they're betting on direction, but because they earn a percentage-based fee on transactions, and that fee naturally grows larger as prices climb higher. Beyond individual investors and banks, there are broader economic ripple effects to consider. Rising oil prices, driven by escalating tensions in the Middle East, don't just affect gold and silver. Higher energy costs tend to filter through to transportation, manufacturing, and eventually consumer prices. This creates a connected chain. Geopolitical risk drives oil higher. Oil and uncertainty together drive gold and silver higher, and all of it eventually touches household budgets in some way. There's also a social dimension worth examining. The impact of misinformation itself. When rumors spread about supposed gold shortages, secret government plans, or dramatic revaluations, some investors make decisions based on fear rather than fact. This can lead to buying at inflated prices out of panic or selling prematurely based on false expectations. Financial analysts consistently emphasize that decisions built on unverified claims tend to hurt everyday investors far more than they hurt large institutions, who typically have access to better information and more sophisticated risk management tools. Looking specifically at China's regulatory changes, the implications are mostly protective rather than disruptive. By phasing out unregulated leveraged retail products, Chinese regulators are aiming to shield smaller investors from products that had previously led to significant losses for some participants. Critics might argue this limits certain investment options for retail traders. Supporters counter that it closes a door that had already caused real financial harm to individuals who didn't fully understand the risks they were taking on. Both perspectives have some validity, and the outcome will likely become clearer as retail investors shift toward the alternatives that remain open to them, such as gold ETFs and savings plans. Meanwhile, the platinum and palladium markets tell a somewhat different cautionary story. Both metals saw sharp price increases over the past year, driven largely by investment speculation rather than genuine industrial demand. Platinum, for example, traded in a fairly stable range for roughly a decade before suddenly spiking as rumors of major shortages and rising demand from certain markets circulated. Investors poured in during that period. However, much of that buying has since reversed, with significant selling already recorded in exchange-traded funds. This serves as a reminder that price spikes driven mainly by speculation, rather than real supply and demand fundamentals, often prove difficult to sustain over the long run. Taken together, these consequences show a market shaped by a mix of real economic forces, technical trading patterns, and human psychology. Genuine risks from global tensions and shifting supply are colliding with speculation, misinformation, and regulatory change all at once. For everyday viewers, the lesson isn't to avoid these markets altogether, but to recognize which forces are genuinely driving prices and which are simply noise. So, where does all of this leave things heading into the coming weeks? Based on everything covered so far, a few clear things stand out and a few questions remain open. On the technical side, gold is sitting right at that critical downward trend line analysts have been watching. If prices manage to close above it, many chart-focused traders believe a short-term rally could follow, potentially testing new highs before eventually cooling off again. Silver appears to be following a similar pattern, though it still has more room to move before reaching its own key resistance level. Analysts following these markets closely have suggested that any spike, if it happens, may not last long, with prices possibly easing back toward that earlier support level once the current wave of buying and contract rolling works its way through the system. The COMEX rollover process is also worth watching directly. As the remaining August contracts continue getting bought back and shifted into October and December, that activity alone could add short-term upward pressure on prices. This is expected to play out over the next couple of weeks, right around the start of August. Geopolitically, much will depend on how tensions between the United States and Iran develop. Any further escalation, particularly around shipping routes or oil infrastructure, could continue pushing both oil and gold prices higher. On the other hand, any signs of de-escalation could just as easily reverse some of that momentum. This is one of the more unpredictable factors in the equation, and it's worth watching closely in the days ahead. As for China, no further dramatic changes are expected in the immediate future. The final phase-out of leveraged retail trading has now been completed, and the country's gold market structure, physical bars, savings plans, ETFs, and institutional futures trading is expected to continue functioning as it has. Viewers should be cautious of any new claims suggesting sudden drastic shifts are coming from Chinese regulators, since history shows these kinds of rumors tend to resurface again and again, usually without much substance behind them. Now, here are a few questions worth thinking about. If gold does break above that key resistance level in the coming days, will it hold, or will it pull back just as quickly as it climbed? Do current global tensions feel like something that will ease soon or continue building? And when it comes to precious metals, how much of the recent price action feels driven by real economic fundamentals versus speculation and headline-driven trading? Viewers are encouraged to share their own thoughts and predictions in the comments below. For anyone looking to stay informed going forward, a few simple habits can help cut through the noise. Following verified market analysts, paying attention to actual regulatory statements rather than secondhand claims, and understanding the difference between technical trading patterns and genuine supply and demand shifts can all make a real difference in how someone interprets these markets. At the end of the day, gold and silver remain two of the most closely watched assets in the world, and for good reason. They sit at the crossroads of politics, economics, and human psychology all at once. Sorting fact from rumor isn't always easy, but it remains one of the most valuable skills any investor can develop, especially during periods like this one when prices are moving quickly and headlines are moving even faster. That brings us to the end of today's video. Thank you for spending this time with Currency Matrix and for taking a thoughtful, level-headed look at what's really happening in the gold and silver markets right now. If this video helped clear up some of the noise out there, consider giving it a like, sharing it with someone who might find it useful, and subscribing if you haven't already, so you don't miss what happens next. Until next time, stay informed, stay grounded, and take care of yourself and those around you.